Greetings, everyone. I hope you had a lovely Thanksgiving. This is Cathie Wood, CEO, CIO of ARK Invest. And for those of you who have not listened in before, I started doing these videos right after COVID started because we had a differentiated point of view on what was going on in the economy. Many investors were fearful that we were going into a depression. And we looked at the juxtaposition of massive stimulus against supply shortages, and we said, oh, we're going into a V-shaped recovery, and boy, did we ever have that. And of course, the last 2 years have been characterized by fears of inflation and interest rates going higher and ever higher. And both went higher than certainly we expected. But then again, the supply chain problems lasted twice as long as we would have expected, exacerbated, of course, by the war in Ukraine. But we do think we're coming to the end of all of those disturbances, and hopefully the coast will be clear for a much better new year. So as usual, we'll go through fiscal policy, monetary policy, some economic indicators on this Employment Friday, some market indicators. We'll talk about the crypto landscape in particular because of the bankruptcy of FTX and all of the disturbances around that. And then finally, we'd like to share some thoughts on the profitability associated with disruptive innovation. Actually, it's the latent profitability. So we'll go into that a bit as well. I'll touch on each of these fairly quickly. There's not much to say about fiscal policy, except we did have the election, and as we expected, we are now in gridlock. Again, there's no one-party control. And in fact, the differences are even fewer than we expected in terms of majorities in the House and Senate. So it's probably going to be a year of not much of anything happening, except perhaps for a gearing up for the national election, which of course will be in 2 years. What was interesting about this election and its ramifications is it did not hew to James Carville's famous quote, "It's the economy, stupid." Because if it had been about the economy, inflation, interest rates, housing unwinding, I think the outcome would have been a bit different. So there are other issues out there. Economics is only one. We think that economics, though, might become a more important issue generally in the next year, mostly because of monetary policy. So let's go into that a bit. Money growth, as measured by M2, is down to 1.2%, a little lower than we expected for October. And by the end of this year, it should be negative. Now, that is from a peak in 2020 of 27%. Clearly, that was excessive. We were throwing everything we could, or the Fed was, at the coronavirus to prevent a depression. But we have now seen declining money supply really since March. And I had the pleasure and the honor of doing a podcast this week. I think it will come out the week of the 22nd with Jeremy Siegel. And Jeremy has very strong feelings about what the Fed is doing right now. Essentially that it's making a big mistake. Now, we've been saying that. Jeremy Siegel is a student of economic history. He actually taught at the University of Chicago with Milton Friedman for a number of years and got to know him very well. I think Jeremy thinks that Milton would be, as the saying goes, turning in his grave if he saw what was going on with monetary policy these days. Negative money growth is very serious. And in fact, we've never really seen a real bout with negative money growth since the Great Depression in the 1930s. So he's on high alert and again thinks the Fed is making a big mistake. And it's not just the Fed. I just saw this week Singapore's money growth on a year-over-year basis is down nearly 7%. And we heard the ECB, the European Central Bank, Lagarde, in the last few weeks talking about needs to play tough with inflation when Europe is clearly in a recession. So it's quite concerning. One explanation for this is that banks have not been increasing the interest rates on demand deposits enough to attract more deposits. In fact, quite the opposite is going on. Deposits are leaving for money market funds, which are paying higher rates. And of course, what that means is that this money is not in the system to stir economic growth and to support loan growth. So that's very interesting. And we do think the Fed is beginning to understand that it is close to the end of whatever it is doing. And I think the market, the equity market, which has been basing since June, is beginning to understand the same thing, but concerned that, rightly, that the Fed will make a mistake that will cause a crisis of some sorts. The one interesting thing that has happened in the last week was Chairman Powell's speech at the Brookings Institute. And as he was talking, he referenced a few variables that we've been thinking are very important, and we're happy to hear him cite. One is that, monetary policy does act with a lag. And it's not just our monetary policy we should be thinking about. It is global monetary policy. And if you look at when central banks around the world started raising interest rates, it was well before the US did. It was about 2 years ago, and the Fed really only started 7 to 8 months ago. And so it is this monetary tightening around the world that will impact economic activity during the next year or so. And of course, all we've seen is tightening, and so the odds are high that economic activity during the next year will be disappointing. So happy to hear him talk a little bit more about lags and that the Fed has to be cognizant about lags, and then also to hear him talk about rents and how rents, as they get into the CPI in particular, are lagging indicators. And he cited a number of measures that are rents or rent-like, one of them being leases and the rate at which they're turning over. And this is for real estate. And he noted that the rate of growth on a year-over-year basis is decelerating sharply. And that's because we're seeing other indicators like the S&P Core Insights, I think that's the name of it, measure of home prices, down 3 consecutive months in a row. We have not seen this. And we have not seen the depth nor the extent of declines in the housing market as measured by prices since 2008, 2009. So he's on high alert, and that's good. And I do think the market took a little bit of comfort from that today. Now, we named this this month's webinar "Pivot?" And some of my colleagues reminded me of the Friends episode where famously they're moving in and the leader of the band is saying, "Pivot, pivot, pivot." And of course, it didn't work. It didn't work. And so we just have to hope that when the Fed does pivot, and it will, that it will work. If it doesn't work, what will have happened is the equivalent of what happened to the Depression in the 1930s, and that was when the Fed finally did change its spots. It didn't work. It was called a liquidity trap. They pushed money out there, and it didn't take hold. There was just too much fear. I don't think we're going to get to that spot, but it is a risk, and we can't deny it. So we titled this episode not only Pivot, but Leads and Lags pointing to a pivot. I'm sorry, Lags and Leases pointing to a pivot. And the fact that Chairman Powell is talking about lags, talking about being less aggressive in interest rate increases, 50 basis points instead of 75. I mean, we would say they shouldn't do anything at all, but at least they're softening that tone. That's good news. The only bad news is he's now saying, yep, the rates will probably go higher than we envisioned just a month ago. We don't think that's good news at all. And we also don't think it's going to happen, the 5% plus. The other thing to note is the balance sheet, the Fed's balance sheet is shrinking by roughly $93 billion a month. Now, there's a debate about what this really means, but the San Francisco Fed says that if you add that to where the Fed funds rate is today, which is roughly 4%, that tightening would be the equivalent of a 6.3% Fed funds rate, all other things equal. Now, already the yield curve, so the difference between short-term interest rates and long-term interest rates, is negative. It's unusual, of course, for long rates to be below short rates. And that what that usually means is that inflation and or real growth are going to disappoint or surprise on the low side of expectations. And we do think both will happen. But if we took that 6.3% equivalent Fed funds rate, literally, we'd be dealing with a 280 basis point inversion in the yield curve. And that would be a record. That would be even more inverted than when Chairman Volcker was strangling the economy or strangling inflation out of the economy in the early 80s. But think about that. 280 basis points, 2.8%, on a 3.5% long bond yield is a lot different from 2.8% on a 15% bond yield, which is where we were in the early 80s. And I do think we're going to see some cracks in the system because of this. Now, some would say the UK's LDI crisis, liability-driven investing crisis, was the first, and we would agree. The crypto fallout might be the second, although we would submit that fraud is the bigger problem there. But something interesting did happen this week. Blackstone's REIT, it's a $69 billion fund, the largest real estate fund in the world, available to retail investors, really shut down in terms of withdrawals. They are not allowing redemptions now. They had hit the maximum. I guess it's 5% of net asset value each quarter or 2% per month. So clearly through November, they had hit their limit and they've closed it. Real estate is an illiquid asset and it's under pressure right now. Investors know that, and they're trying to pull away. So I would say I don't think that's going to result in a full-blown crisis, but for people who do need liquidity and would like to get their money out, that's a problem. So we found that interesting as well. So what are we dealing with in terms of showstoppers when it comes to the Fed? Well, still employment, and we'll talk a little bit about that in a minute when we talk about the employment report. Headline CPI, still not near 2%. Core CPI, not near 2%. And the stickiness of wages, again, from the employment report, we did get a higher than expected wage rate today. And it used to be rents they pushed against. But again, Chairman Powell started talking a little bit about how deceiving rents in the CPI and I would say PCE are. So let's talk about the employment report as we go through economic indicators here. Well, the unemployment rate stayed at a low at 3.7%, only 0.2 off its low from July and September. Non-farm payrolls were higher. The increase was higher than expected, 263,000 versus the 200,000 expected. But on the other hand, this is a typical economist way of looking at the world. If you look at household employment, that was very disappointing. It declined 138,000. And the divergence between non-farm payroll and household employment is stark. Since March, non-farm payroll jobs created have been 2.7 million. Household jobs created, practically zero, roughly 12,000. So that's since March. And think about that. That is when money growth started declining on a sequential basis. I don't think that's any coincidence. So the other indicators of employment that are pointing down include the Challenger layoff survey. It spiked by more than 400% in the month of November. Now, typically we don't see that except when we're in a recession, that kind of spike. So that's another indicator. And the last one in the employment report itself was the average work week went down 0.1 of a point. Now, this is a pretty stable number. So when it declines, I take note. And it's basically businesses saying, okay, it was so hard to find this employment. I mean, these employees, that I'm not going to lay anyone off right now, but my business is down, so I'll maybe cut the work week and cut overtime. So that's also interesting. And, the more this divergence between non-farm payroll and household extends, the more I think the economic indicators are going to start becoming quite weak. I think household always catches the turn in a cycle. And as you know, we think the cycle did turn as household employment was turning in March, and that we fell into a recession then. And probably revisions will cement the case for that. But right now, GDP for the third quarter did come out up. Now, a big part of the reason was imports collapsing as companies tried to clear their shelves of inventory. So that's not exactly a ringing endorsement of how strong the U.S. economy is. Average hourly earnings did increase 0.6%. The expectation was 0.3%. That took the year-over-year wage inflation rate up from 4.9% to 5.1%. And the Fed's definitely watching this. Now, a counter to that is this work week decline means that total income, so average hourly earnings is just an average, but total income, when you measure all the hours, is not as strong as that wage growth would suggest. And then just looking through the indicators that came out this month, just trying to be pretty even-handed, strong versus weak, and inflationary versus not inflationary. We did see retail sales come out and personal spending stronger than expected. Retail sales up 1.3%. I think autos distorted it quite a bit as supply chain issues have eased up. Auto sales, I believe, went from 14.3 to 14.9, 14.3 million at an annualized rate to 14.9 in the United States in the month of October. But we just got a report yesterday that they fell back to 14.1. So 14.9 to 14.1 is really going to hit retail sales hard when November is released. We are on the weaker side when it comes to the consumer. We're seeing a couple of startling things. Number one, the saving rate is near an all-time low. It's at 2.3%. I think the low was in 2005 at 2.1% after all the revisions. I remember back then it looked like it was negative. And another manifestation of that is consumer credit. So consumer installment credit is going up dramatically. It has for the last 6 months, I think. And typically when the consumer is struggling, drawing down the saving rate, one of the, again, manifestations of that is not paying off the full balance or paying off much less than normal. That shows up as a decline in the saving rate and increase in consumer installment debt. So we are seeing that. We're also seeing on the consumer side record negative sentiment as measured by the University of Michigan, and it deteriorated again this last month. So we're back into the early 80s. The survey did say that inflation expectations for the next 5 years on average ticked up from 2.9 to 3%. And I think that's because that was in reaction to gas prices, which have since come down. Then on the housing front, we got a surprise, a positive. New home sales up 7.5% month to month. I kind of think that was a fluke. Because if you look at the National Association of Home Builders, its index, it's really a sentiment index of how conditions are out there, are nearly as low as they were at the bottom of COVID, the low during the COVID crisis, and back where they were during 08-09. So very weak sentiment there. And pending home sales, and this would be new and existing, are down 37% on a year-over-year basis. And then finally, as I mentioned before, home prices, as measured by CoreLogic S&P, have dropped for 3 consecutive months. Again, we haven't seen that since 08-09. And I think that's why Chairman Powell started talking about rents and giving himself some wiggle room to change rhetoric and then to pivot, actually pivot. And then finally, on the manufacturing side, we're seeing strength in non-defense, new orders for non-defense equipment, autos, and defense. And that was up 0.7. And I do think this speaks to the reshoring of manufacturing here in America. So that's good. But at the same time, we're seeing one purchasing manager index after another, both manufacturing and services, contracting now. They've moved into full contraction territory after equivocating around 50, the demarcation point. They're now into the 40s. So I would say, on balance, the economy is, if not in recession, we do believe it is in recession. It is. Most people will be convinced we're in recession in a few months. Now, moving on to market indicators. As I mentioned earlier, the equity market has been in a trading range for the last, since June, I would say, so 5 to 6 months, trying to figure out, is the Fed going to cause an accident and cause a recession from which it will be hard to extricate ourselves? We believe, if we had to take a position on that right now, we believe this recession is much more of a supply chain related inventory recession, and that it will clear up pretty quickly. Although, economic statistics are so lagged that come this time next year, we might still be arguing if we're still in recession. But we do think in that period, both inflation and interest rates are going to come down pretty dramatically. Inflation below 2%, and interest rates, I think, will be surprised. Jeremy Siegel thought that we would see 2% interest rates next year. I found that very interesting. We do see one market suggesting that this point of view is correct, and that's the bond market itself. Bond yields peaked on October 22nd, I think, at 4.3% and are now down near 3.5%. That's a pretty dramatic drop in the bond market. And the yield curve is now, if you look at the 2s to 10s, I think it's inverted by 77 basis points. Again, a very steep inversion given the level of interest rates we're at. Commodity prices, one of the most influential from a sentiment point of view is oil. It peaked at $130 on March 7th of this year and is now down to 80, despite the fact that we're getting all kinds of reasons for the oil price to turn back around. One is OPEC is concerned at the excess supply out there and is threatening to cut production even more than it already has. Two, China is starting to stimulate, although it's stop and go. From a monetary point of view, they are stimulating. COVID-0 is a problem. There's some signs that they want to loosen that up. And if they do, then that will increase the demand for oil. And then, of course, our strategic petroleum reserve, we have to start putting oil back into it. It's back down to 84 levels, 1984 levels. So that will be another incremental source of demand. Nonetheless, the oil price keeps going down. What's fascinating to me is in the face of that, the XLE, which is the S&P Energy Sector Index, is near an all-time high. Now think about it. The oil price has gone from 130 to 80, and typically that index trades with the oil price. It has not this time. It clearly expects all the variables I mentioned to boost oil prices once again. But if we're right, that may not happen because the move to electric vehicles is I think, faster than most people expected. And we're now beginning to see some Ubers and Lyfts, we're seeing more Teslas in those fleets. And so the vehicle miles traveled in electric cars, given that these Uber and Lyft drivers drive a lot more than we do in our individual cars, we think that's going to cut back on the demand for oil more than many people appreciate. And as are all commodities, prices are determined at the margin, the marginal, incremental demand. And in our view, the incremental demand is going to fall short relative to expectations. And our call from a while ago has been that oil demand probably did peak in 2019. We may get back there, but if we do, it will be for a very short period of time. Copper prices have, as I've mentioned before, have come down from $5 in March to $3.85. During the past month, a number of commodity prices have had a bit of a rebound. I think that's partly because the dollar has come down and commodity prices are based in dollars. The other market to focus on and try and glean some information from is the crypto market. And I think in our last In the Know video, we were remarking and impressed that Bitcoin had been much more stable. It was in the 17,500 to 23,000 range. It had been more stable than the equity markets and the bond markets. And we thought, wow, that could be a leading indicator. Maybe Bitcoin's going to be a leader in the next bull market. And then, of course, early in November, FTX went bankrupt. It does appear that there has been fraud involved. Now, what we took from the price break associated with it, if you looked at a chart of Bitcoin, as many technicians have from the beginning of this year, they've basically said this thing's going back to 10 to 12,000. That's where it has support. It doesn't have much support between here and there. Well, guess what? It stopped at 15.5 and it is now around 17. So it has withstood a massive amount of uncertainty in terms of what's going on in the crypto market. And one of the things we have been impressed by is how the Bitcoin blockchain and Ethereum, neither one of them skipped a beat in terms of operations. No transactions interrupted at all. If you think back, if you were in the markets in 2008, 2009, the markets froze. Banks stopped processing. They didn't know where the counterparty risk was, and the absence of information, the absence of transparency, the market froze and the Fed had to come in. It was a near-death experience for the global financial system. Well, it has not been a near-death experience for crypto. And it's highlighting how important transparency is. We can see every transaction on the network by IP address. We can follow the money by IP address. And the decentralization of the network is also paramount. You know, it was very interesting that Sam Bankman-Fried never liked Bitcoin. Well, it's becoming obvious to me now that I know he never liked it, why he didn't like it. It's because it's not centralized. There's no way to control it, like he was controlling his empire. So it highlights this, the dual nature, decentralization, transparency, and regulators are beginning to understand this. The newest SEC commissioner, Jaime Lizarraga, still getting used to his name, he highlighted how important decentralization and transparency are, and a lesson learned from this crisis. And so from a regulatory point of view, the focus on those two variables could be very good for the crypto asset ecosystem. And then just to put into perspective the fallout from crypto, at its peak, the crypto asset ecosystem, all of it, I think there are more than 10,000 crypto assets. Most of them, or many of them, will not be worth much, but there has been a lot of speculation. The entire crypto asset ecosystem hit somewhere between $2.9 and $3 trillion. Is now down to roughly $800 billion. Now, put that in context. Apple is a $2.3 trillion company, one stock. So that just gives you a sense of how early we are still, and how unlikely it is that what has happened in crypto could cause a systemic financial crisis. Now, we probably are going to see more fallout, and we think we can dimension it. One of the ones I think we have a lot of facts on this. DCG, Digital Currency Group, owns Genesis, and it may have borrowed roughly $1 billion from Genesis. So $1 billion, it could be between $1 and $2 billion. Now, to give you a sense of that, the Lehman Brothers bankruptcy claims were $1.2 trillion. So we're not talking anything like that. We are talking counterparty risk, again, shades or echoes of that crisis. Reinforcing this idea is with transparency, you will have a much better understanding of counterparty risk. With decentralization, the counterparty risk should be lessened. Closed ecosystems are not a wise idea, and human-driven decisions, especially in a moment of a crisis, as opposed to smart contract automated decisions, also tend to be, if not irrational, then in the case of Sam Bankman-Fried and FTX, possibly fraudulent. So I think every time we go through a battle test of the crypto asset ecosystem, I feel better. I feel better. If you look at the trajectory of Bitcoin, while the swings are wild, as Jeremy Siegel said on our podcast yesterday, he doesn't think there has ever been an asset where more people have made so much money, even after these losses, in such a short period of time, 12 to 13 years. So our conviction is as high as ever. And you will see from our Bitcoin Monthly, which will be out on Monday, how our on-chain analytics look even after this battle test. The outlook is positive based on-chain analytics that show massive capitulation that we typically see only at bottoms. And that's why we're so impressed. We didn't get back down to 10 to 12,000. You know, a lot of the traders and hedge funds involved in crypto just look at the charts and press and press and press and press until they get what they want and get what they believe will happen. Well, that didn't happen. Now, I'm not saying it won't, but I think the odds have gone down quite dramatically. And truly impressed at the relative stability, especially in Bitcoin and Ether to some extent. So with that, I'd like to end on one subject, and that is the profitability associated with disruptive innovation. Now, many of you know that the pundits out there, whether they're in the media or in our own business, have characterized what ARK does as profitless tech and concept capital or tech wreck, and have equated what we're doing to what happened during the tech and telecom bubble and the bust. In fact, our strategies have behaved worse than during the bust, even though so many companies went bankrupt, so many companies that should not have existed back then went bankrupt in the NASDAQ. They had gotten into the NASDAQ and they went bankrupt. And yet the price decline in the NASDAQ back then was not as severe as our own price declines, at least for some of our portfolios. It makes no sense because the seeds for what is happening today in innovation were all planted during the 20 years that ended in the tech and telecom bubble and then the bust. There was too much capital chasing too few opportunities too soon. And that's why there were so many bankruptcies. Now we do not believe that's the case. We are ready for prime time. And you can take a look at our research for many examples of that. And so what we encourage our companies to do, now that we are ready for prime time, is to invest aggressively right now to capitalize on some of the most important investment opportunities of our lifetime, of the last, really ever. We believe that the market cap associated with truly disruptive innovation, transformative innovation, will go from 7 trillion now, less than 10% of the global equity market cap, to 210 trillion in the next 8 to 10 years. That's a 30-fold increase. That's exponential growth. And I think that a reason a lot of people have trouble with our strategy is we've grown up in a world of linear growth. And the last time many investors heard the phrase exponential growth was in the tech and telecom bubble. And there's a lot of muscle memory associated with that. Many of those managers became value managers. I know, and I hear them denigrate our strategy, perhaps because of their experience. We've been doing the real research on disruptive innovation. And according to Wright's Law, and according to all the learning curves, cost declines, and so forth, we are ready for prime time in the 5 areas around which we have centered our research and investing. Multiomics, so what we used to call the genomic revolution, robotics, energy storage, artificial intelligence, and blockchain technology. The technologies are ready. We didn't even get the cloud until 2006. We didn't have the big breakthrough in deep learning until 2012. We didn't get the cost of DNA sequencing down to $500 per whole human genome until this year. So, but we're ready for prime time now. So we've just finished one holiday, and we're going into another series of holidays during the next few months. So, of course, we wish you a wonderful holiday season, but just let me leave you with one thought and hope. This is the hope. And based on our research, I think this is really possible. So if you look back to the last time we had multiple innovation platforms evolving at the same time, telephone, electricity, and the automobile in the early 1900s, what you found is we were at a period very similar to where we have been very recently. There was a pandemic, the Spanish flu. There was a war, World War I. Now, both of those were much more serious than what we've experienced this go-around. We are an echo of that. Inflation hit 24% in June of 2020. And by June of 2021, it was down to minus 15%. And now, as Jeremy Siegel reminded me, we were on the gold standard then. So they needed to try and get prices back to where they were before the pandemic and war. But the echo here is money growth is falling, just like it was then. So we believe that the drama there, that 24% to minus 15%, in inflation from 20 to 21, that we will see something akin to that, an echo of that this time around. So we got to 8, depending on the measure, 8 to 10% inflation here in the United States. Europe's at 10% right now. And we would not be surprised and agree with Jeremy Siegel that we could slice through 2% at some point next year. Commodity prices are already pointing in that direction. Massive discounts over Christmas because of overwhelming inventories are pointing in that direction. And so I'll just say one last thing. When we first moved to St. Petersburg, it was about a year ago. And I remember walking out around the park to go take a walk. And I ran into a woman named Cheryl. I think her name was Cheryl. Could have been Shirley. She was on her bike. She had a little dog. And she recognized me and ARC, knew all about ARC, read our research. And I think, and she pulled up her app with, our portfolios. And again, about a year ago, and this is as tough a year as I've ever had. This is worse than 0809 by far. And I think of her every day, and I think of all of our clients every day. And I know that patience will win out. And I'm not sure if Cheryl is still in our funds, but know that I take these things very seriously. But I also know that we cannot pivot from our style. Style drift in our business is suicide. And our focus is exclusively on disruptive innovation. We would not hedge with energy stocks. The energy index is at an all-time high despite oil prices falling from 130 to 80. That makes no sense. But we're seeing a lot of people drift, even if they have ESG mandates. So we will not drift. And we know that our research is pointing us in the right direction. If anything, in the last year, our conviction in our research has increased because the artificial intelligence breakthroughs that we were expecting 5 years from now, maybe even 10 years from now, are happening now. GPT-3 chat, or chat GPT-3, it's mind-blowing. So I think truth will win out, patience will win. And we're looking forward to more in the know videos, sharing our insights and thoughts in the new year. And by which time, at some point, we expect the pivot to have taken place. So with that, have wonderful holidays, and I will look forward to doing more of these in the knows in the new year.